Welcome everybody to SEC Filings 301. We're just going to have a little brief talk about lockup periods. Again, we're at Investopedia. Just type in lockup period and it'll explain what that is. But just real briefly, it's a window of time when investors are not allowed to redeem or sell shares of a particular investment. There are two main uses for lockup periods, those for hedge funds and those for startups, IPOs, etc. And so basically what this means is there's a period of time where you cannot sell. So if you're going public and you're buying into this stock, you're saying, you know what? Um, Usually it's a period of 180 days, but it can change. And it can be less and it can be more. They can extend it. Um, and for hedge funds, lockup periods tend to give the hedge fund manager time to exit and invest and are typically 30 to 90 days. All right. Now, let me explain something to you here. Uh, and I want you to understand that it is everyone versus you in the market. Every single person, just pretend like you've gone to some, I don't want to say any country or city or whatever, wherever you are, wherever you think there's a place where there's a million people around you and they're all trying to pickpocket your wallet. They're all trying to take it out, right? They're all coming up, bumping into you, trying to pickpocket and take all your money. Well, that's the market. Everyone's trying to take your money. Everyone is trying to take your money. Okay, that's the way the game works. It's a net neutral game, right? It's somebody loses, somebody wins, somebody loses. It can't be any other way. So with that said, all the lockup period is to make you feel warm and fuzzy. Okay, well, they're not selling, so I'm safe. Okay, well, I can give you plenty of examples of when lockups were removed and changed. And I am not an SEC lawyer. I don't know and understand the legalities behind everything. An example of it was Beyond. The Beyond chart just shot through the roof, and the people wanted out. They figured out a way. They got out, and they sold. Okay. So with that said, understand that yes, this is how it's supposed to work, but it always doesn't work this way. Um, so key takeaways from this: lockup periods are when investors cannot sell particular securities. But I promise you, you have money, the government will figure out a way to help you make that money so you can give some of it to them. Lockup periods are usually to preserve liquidity and maintain market stability. Hedge fund managers use them to maintain portfolio stability. That's a bunch of BS, but in my opinion, I'm not a hedge fund manager, but startups IPO use them to retain cash and show market resilience. So there's an example. I think it was NKLA, the guy that owns it. I forgot his name, Trevor Milton. He said, you know what, I'm extending my lockup period to show you that I'm not going to sell, that I'm a believer in this company, and they do that to show you, hey, we really believe and we don't want to get out, right? We want to hold our position. And a lot of reasons people don't want to take on huge positions of companies is because they don't want to hold them for a certain period of time. So a lot of pump and dumps, what you'll see is by 2:30, they start dumping their shares. And on my other videos, you'll hear me say when dealing with low flow pump and dumps, by 2:30, if it's continuing to go up, then they're looking for a higher close, or it's the real deal. So what'll happen is in pre-market, it's easy to run shares up, right? And then the market opens right here. Usually what happens is you have this back and forth battle and shoots up and then it just rolls over and then it's right. Well, let's pretend this line is VWAP, and a lot of times what will happen is, it'll work its way back up and then pop up. And let's say right here it's 2:30, right? This is the time for 2:30. And they're like, "Ooh, let's run it back up so we can get our final dump." And then they start dumping into it. Okay, that's what happens a lot of the times. But what happens if it's past 2:30 and it keeps going up, it's like, okay, whoever's buying this is going to have to file a 13D or a 13 beneficial form of ownership, right? So the other thing to remember is Which one was it? I think it was this one. No, it wasn't that one. It was this one, this form right here. So there's, again, guys, there's endless resources on the internet to learn things for free. That's why I'm here to just organize these things. You can dig into them more. But when you go and you can learn about this on your own, you can come in, and depending upon who you are is dependent upon how much time you have to tell people that you've bought. So must file with the SEC Schedule 13D within 10 days after the acquisition. So if I came in and I bought, let's just say 20% or 15% or 11% of the company, or even 6%. So see how right here it says more than 5%. So if I bought 6% of the company, I've got 10 days to file. So if a company is running up, you've got 10 days to file. And if you don't, you're in trouble. Now, if you are a person that qualifies as an institutional investor, well, then you have 45 days to do it. And then it goes on for, I think there's another one for foreign. Yeah, but that's the reason that they do this is to let people know, hey, I'm an owner, right? And the reason people want to sell at 2:30 is because they don't want to be a 5% owner. At 10:30, they may lock up the float. Maybe it's a million share float. They've locked it up and they're just running it up. Well, by 2:30, that gives them enough time to start selling off without just completely dumping and crushing the stock price. They can slowly do it and give people hope that it's going to bounce, and it just slowly dwindles down. But that's the point of lockup periods. And if you have any questions about it, just let me know.